Let me take you through a hit list of further rules. This is just a quick hit list, and again, it's one of those things where you might want to keep it on your desk as a bit of a reminder. So, first of all, don't be involved in too many positions. It's a classic basic mistake. It leads to neglect of some of those positions. I like to have open 3 to 5 positions max at any one time when I'm swing trading, and the reason for that is any more than that, it's very difficult to monitor. It's very difficult to give equal attention and research to each. And don't forget, if you've got between 3 and 5 open, you've probably got a couple that you're looking at, which is sort of your substitute in case any of your trades come to fruition. So in actual fact, you're probably monitoring about 7 positions. That's a lot to simultaneously monitor. Remember, the primary objective is to maximize profitability. And that means the probability of a gain multiplied by the expected gain. So it's not just that, oh, I think this stock's going to go up 10% or 15% or 30%, but multiply that by the probability. That's what your expected gain is. And the probability for most of the chart patterns I'm going to discuss of it actually hitting the sensible targets that we're looking at is 70%. In other words, 7 times out of 10 it'll actually do it, 3 times out of 10 it won't. 7 times out of 10 you'll have a win, 3 times out of 10 you won't. Multiply that by the gain, so if it's say 30 pence for argument's sake, then it's 0.7 times 30 pence, which is what your expected gain is. So don't count all your chickens before the eggs have hatched. We're looking at 70%. We should still be able to make money even if it gets down to 50. Predetermine your exit before your entry. The reason for this is that once you've entered a position, everything changes. You become more confident, or you become too emotional. Whatever the reasoning, what you've got to do is ensure that either way you set that exit level before you enter when you've got the clearest head. And many people don't do that. They lack the clarity that they would otherwise have got if they did it before they enter a trade, and that leads them to getting too emotional once they're in a trade. You must know why a position was opened, and like I say, keep a journal, why it was opened, what you expect it to make. Again, put this in the journal so you can refer back to it. It's easy to forget it if it's all in your head and your emotions can take over. How long it was expected to take, and what the risk was. Once you've got all of those things in your journal, then you've got a good idea of why you're looking at a trade, what it's for, and so forth. It gives a lot of clarity. Once you obtain competency, diversification is undesirable. A lot of people think, oh, I've got to get into this, that, and the other, do lots of different types of trades, systems, signals, all sorts of things. Well, actually, once you're good at a particular area, you don't want to be learning all sorts of new tricks because it'll only detract from your core competence and your core focus in any event. So that's an important point. Risks are controlled by care in selection and a large cash reserve. In other words, you don't take unnecessary risks through being a bit haphazard in your selection, in just buying willy-nilly. Equally, risks are best controlled when you've got a lot of cash in reserve, as opposed to what many private investors do, which is bet the ranch on a series of trades in the hope of making the money very quickly and very fast. That's not how professional traders do it. Decide at what point you will know things have not worked out. I keep on referring to this. Risk is the difference between the cost and the sell point. That risk ought to be less than the cost of the trade and where you expect it to go on a profit basis. That way your risk is lower than your reward. And know your outcome. Know your outcome. Develop a plan of action and reevaluate it. Homework, hard work, and discipline. There's no way around it. You have a journal. Of course, all of this gets a lot quicker as you become more experienced and more used to it. But have a journal. Work out why you entered the trade, where you expect it to go, what you'll do if it doesn't make it. That will mean that you're just following your recipe book or instruction guide once you're actually in a trade, as opposed to wondering, what should I do now? Where might this go? That's very amateurish. You shouldn't do that.